Welcome to Acton Line, a product of the Acton Institute promoting a free and virtuous society. I'm Mark Townsend, producer. You can find additional resources in the show notes for this episode, as well as previous episodes of Acton Line at acton.org/podcasts. If you have a comment or an idea for a future episode, you can email us at podcast@acton.org. Acton Line is available to stream on Apple Podcasts, Spotify, YouTube, and acton.org. This episode of Acton Line was recorded at Acton University, our flagship conference. Acton University is a 4-day exploration of theology, philosophy, entrepreneurship, international development, and market-based economics. Each day is filled with thought-provoking presentations on the intellectual and practical foundations of a free society. At Acton University, you can sharpen your intellect, expand your worldview, and learn the foundations of genuine human flourishing. To learn more, visit university.acton.org.
Welcome. My name is Dan Huger, librarian and research associate at the Acton Institute. Today I'm joined by David Bahnsen, founder, managing partner, and chief investment officer of the Bahnsen Group. David also serves on the board of directors of the Acton Institute. And today we'll be talking about the American economy, the sort of ever-shifting policy environment, and ever-increasing public debt. David, welcome to Acton Line. Thank you for being with us.
Great to be with you.
So it's been a long time since we did an episode focused on the economy on Acton Line, and part of that is we've had an ever-shifting policy environment, and there's just been a lot of changes with the Trump administration, with trade policy, with regulatory environment, and there's a lot of angles to cover, and there are not many people that can address all of them with some competence, and you're one of those people who can. So I guess I'll just open by saying, what is the state of the American economy today?
Well, I hope I can address it with competence, but even I cannot address it with great clarity in the sense of that ever-shifting landscape you talk about is ongoing. It wasn't just that a couple months ago there were a lot of moving parts, and now it's really stabilized. From the trade and tariff picture to the state of housing, which is an underrated component in a lot of things happening underneath the surface in the economy, to obviously the impact of national debt and where annualized budget deficits are going to go. The regulatory atmosphere, there was a lot of talk about DOGE earlier in the year. The labor market is a major perpetual issue. There's a sort of permanent shifting of various circumstances in a lot of these elements, that we're not likely to get to a stable equilibrium anytime soon, but responding to some of those ebbs and flows is kind of the job of the economist. It's certainly my responsibility in terms of stewarding client capital. And I think that you have to sort of divide it up into short-term picture and longer-term picture. And there's a little more clarity on the longer term and a little less on the short term.
Yeah. So of all of the changes that we've seen, there's good news and there's bad news. And I think one of the things that's undercovered is the good news. Like bad news gets a lot of attention. Bad news leads to a lot of market volatility. Good news, though, can have, sometimes go unnoticed, but have better long-term effects. Have there been any positive developments you've seen in the regulatory environment, anything else that is, you think, encouraging for long-term economic growth that we've seen policy-wise?
Well, it's important to point out that the biggest long-term positive is not really related to the policy sphere. The biggest embedded positive in American economy is the American way of life, the fact that it is fundamentally a free market economy. And there's a lot of impediments in that, a lot of things that could be better. There is too much taxation and too much government indebtedness and too much regulation. But structurally, the DNA of our economy is primarily rooted from our birth of a nation to risk-taking, to entrepreneurialism. And that celebration of mobility and vitality leads to a reasonably productive economic order. That's the most intrinsic positive, and that doesn't change president to president, Congress to Congress. Certain policies make it better, certain policies make it worse. But I mean, that's the kind of Play-Doh we're playing with to some degree. That's a very good thing.
So one of the concerns is, you have that entrepreneurial culture. You have a pretty robust set of institutions in the United States, legal institutions that make owning property, selling property, starting businesses, closing businesses. Like this is a lot easier than a lot of other places in the world, and is sort of our comparative advantage over a lot of business cultures worldwide and institutional sort of government arrangements. Is the instability itself maybe the biggest downside in the fact that we've seen a lot of policy changes, particularly with tariffs, where things are on, things are off? If the economy is fundamentally driven by people, risk takers, who are making trying to make informed risks in an unsteady policy environment, does that erode that culture, or do we run the risk of eroding that culture if we have too unstable of a policy environment?
Yeah, the answer is yes, by definition. Now, there is a healthy amount of instability that is always there because of the nature of reality, that there are just certain elements that are unknowable. But then you can compound those unknowables with greater uncertainty, or even worse than uncertainty sometimes is certainty about things that just ain't so.
Yeah.
It can cause a misallocation of resources when you distort economic calculation. A great example of that in modern times is in monetary policy, that I think an unnatural, overly stimulative, or overly tight cost of capital can lead to poor decision-making and bad optics in the calculation that goes into investment. And so our resource allocation is affected when we have limited optics. So changing trade and tariff policies. A few years ago, a lot of the issues going on with some of the woke DEI stuff. Are companies now all of a sudden not supposed to make profits because they're supposed to all be social justice warriors? And even if it was marginal, because all economics is marginal, on the margin, are we going to start focusing a little less on productive behavior and a little more on virtue signaling? Those things were all weighing in. And some of that has normalized, some of it's improved, but there are still uncertainties that weigh on decision-making. 2025, nothing is weighed on decision-making more than trade and tariff policy.
So trade and tariff policy, a lot of the debate has been about, will consumers see rising prices? What are the net effects on this when it comes to jobs, the trade-offs between jobs and consumer prices? But you're talking at a much deeper level, like the ability of businesses to make plans, to develop new products, to offer new services. That's being affected. What are these ways that they're all affecting the consumer? But there are ways that the consumer is affected that aren't just merely reflected in the price of goods that come to market, but also affects the very goods that wind up on the market in the first place, and the way that businesses allocate capital. How do those trade policies affect the decision making of business leaders trying to navigate this environment, and how does that show up to consumers?
Well, first of all, the way it shows up to consumers is not even the primary concern. I mean, I'm a supply sider. By definition, economic growth is generated by production. And the fact of the matter is that I think it's a sideshow to wonder what people will pay for dolls, or how many pencils President Trump is allowing people to buy in their household. That whole conversation, it made for some weird comments, I think, from the White House, and some weird, therefore, responses to the weird comments. But even more than people trying to figure out what the impact to consumers will be, first of all, that is heavily distorted by the fact that the vast majority of these tariffs never happened. So people are looking for price increases from tariffs where tariffs never happened. That is secondary to me to the invisible effects. I mean, this is where Bastiat's teaching and the broken window fallacy is very, very important. A domestic manufacturer that imports unfinished goods as part of their domestic manufacturing process and puts some of that ordering on hold to just wait and see what's going to happen. You don't immediately see a price impact, but what you don't see is the production of those new goods and services. You don't see the jobs that would have been created or wages or profits that would have been created, the counterparty sales that would have happened as a byproduct of this activity that didn't happen. Now, to the president's credit, by sort of reversing his immediate Liberation Day announcement, the worst of all of that inactivity, the worst of these invisible effects, right? Everyone's looking for the negative visible effects. But I think that there's a lot of negative invisible effects that we were spared from by not going forward with all of it. And yet there is still an impact from the uncertainty surrounding that. What will the deals be? Will they get done? Are they going to come back on? And the elephant in the room, even when at the end of the day, if you assume there's going to be some sort of deal announced with Japan, UK, South Korea, India, all which are allies of the United States. But really with China, you're talking about what represents somewhere between 15 and 20% of their exports. About 37% of our imports from China are unfinished goods that are used by domestic manufacturers, 40% of our total global imports, so even higher number total, but 37% from China alone, are relevant to our own U.S. domestic manufacturing processes. So then, of course, if you do get downward pressure on some of that productive activity, then that leads to relevance in job market, in opportunity set, in profits, and the opportunity cost is very substantial. I think that markets have largely priced in. I think that many companies are operating as if one way or another these things are going to work out now, that the president signaled enough to basically say there's been a lot said that is pretty problematic for economic growth, but it doesn't appear to most people he's going to go forward with the worst of it. So a lot of companies are willing to go on. But I got to say, from a smaller business standpoint, many don't have that luxury. They do not have the liquidity, the access to capital markets. They certainly don't have the legal, lobbying, accounting, infrastructure to go get exceptions and waivers and things like that. So it becomes distortive and it puts some downward pressure on economic growth.
So if there's this downward pressure on economic growth, what is that because there's been at the end of the, we've had individual days, weeks where there's been a lot of market movement, but with all of the policy changes that there've been over this period, the market really hasn't been that volatile over that period. At the end of the day, there's been a lot of policy changes, but we don't see substantial difference in market performance.
But that's different than volatile.
Okay, so
you can
unpack
point A can go to point B and land at about the same place. Mm-hmm. Indeed, as you and I are sitting here talking, we're more or less within about half a percentage point right now of the market's all-time high. So someone went to bed on Valentine's Day and woke up on 4th of July, they could be forgiven for not knowing that markets actually have had a heck of a ride in between. But volatile means up and down movements, and there's been a lot of volatility, a lot of variability around the mean.
Yep.
But it is true that it's largely landed back to a place where it started. But that has to do with the tariffs that weren't, not the tariffs that were. So when we speak of a lot of policy changes, I'm not really sure what the policy changes are. For the most part, They've been riddled with exceptions, waivers, delays, and the worst of all of it. I mean, after April 2nd, the announcement that we were moving to a basic system that penalized countries for selling us more than we sold them.
Yeah.
That lasted 4 days, and the market dropped 5,000 points in 4 days. There was significant disruption in fixed income and currency markets. Risk assets were bottomless at that point, and the president's reversal on that was the big stabilizing factor. Then moving to the 60-day delay on the draconian tariff announcement with China, and then all the signaling that went along therewith, essentially removed what we call a left tail risk in markets. That is, that they were really willing to just collapse the economy and go to a full-blown Smoot-Hawley type trade war. That risk was largely eliminated. So then where are we now that's very different than where we were a few months ago? On the margin, there's some higher tariffs being applied in steel and aluminum and on certain parts of the auto sector, but none of it is as bad as was announced. But then there's a lot of uncertainty about where it's going.
Yeah. The other big sort of story has been, what's been called the Big Beautiful Bill. And we've seen estimates from the CBO of this bill. And we look to, America's had a large public debt for a very long time and a growing public debt for a very long time. And this seems to be accelerating it. What are the consequences for that long term and short term? That sort of level of debt and a sort of inability to face sort of fiscal realities in terms of, the United States has a welfare state, where you have big programs like Social Security, Medicare, Medicaid that are consuming an ever larger portion of the budget as Americans get older. And at the same time, you've got increasing debt service obligations that are eating up another portion of the budget. And at a certain point, this becomes unsustainable. And the sort of things that everyone agrees that government should do, common defense, these sorts of things, they become budgetary challenges in this environment. What do you think about, because there's a market angle of this, there's a long-term and short-term angle with this, but then there's also a question of sort of like, there's a political reckoning to be had because of this, because there is no popular support for trimming the major drivers of government spending. President Trump has repeatedly said, said Social Security and Medicare are sort of off limits. There were some Medicaid cuts in this latest bill that.
Well, I would dispute that too, but again, it's just because of the way I define a cut.
Yeah.
If you're spending $670 billion and then afterwards we're spending $810 billion, I don't consider that a cut. I consider that an increase. Yep. But if you were going to spend over $1 trillion and now you're going to spend 810, they're calling that a cut.
Yeah.
And that's just government math. But in the real world, I don't think most people consider that a cut. And it speaks to the inability of the right, the political right, to properly message their own worldview, to properly message their own ideology. Look, they've been substantially handcuffed by President Trump, and I don't for the life of me understand why. Announcing you want to take the only things that can possibly create any real budget reform or fiscal responsibility and announcing you're just taking them off the table entirely with Medicare and Medicaid and Social Security. Now, there's no need for anyone on the right to say we want to go cut benefits.
Yeah.
But to simply announce various reforms and long-term adjustments and sensible things, whether they were bipartisan, like what came out of the Simpson-Bowles Commission that President Obama appointed, or came out of Paul Ryan's proposal from what's now been about, 12 to 14 years ago, there are various elements of what we could do that are not immediate cuts to anyone receiving benefits. But yeah, there is a real orthodoxy at play that these things are untouchable politically. I'm not sure it's true. Yeah. I think that there may very well be a great appetite to go take on these issues with a certain amount of courage. But it is going to take some courage and it's going to take some risk to do so. Now, it's also going to happen.
Yeah.
The question is just, are we going to do it when there's a gun to our head or when there's not a gun to our head? I'd prefer to do the latter.
So what is that? Why is there that preference? Because I think a lot of politicians rationalize this, that, things will sort themselves out. And you know what? We'll cross that bridge when we come to it. And why should we endure present pain when we can prolong it? What makes it worse when we put it off?
Well, what makes it worse is math. And so when the Tea Party movement was running strong, we had 10 trillion of debt, and we now have 37 trillion of debt. When people were piping mad about the Bush era spending going into the Obama era, we were running about 60% debt to GDP, and we're now running over 100% debt to GDP. We basically went through the 90s and 2000s adding around 10 trillion to the debt, but not increasing debt to GDP. The economy had grown at the same pace the debt did. Yeah. But now what has changed is that the economy is growing far, far slower than the debt is growing. And so that amplifies the risk a great deal and puts downward pressure on the growth as a greater amount of resources are needed to go from the productive part of the economy over to the unproductive part of the economy. Now, let's get back to the big, beautiful bill. I would be more critical of it for what it doesn't do than for what it does do. I don't think, look, I'm very critical of its lack of boldness in addressing the debt issue. But I don't think it's true that it accelerates the reckless indebtedness. It slows the pace of it. But that isn't good enough. In my opinion, I don't know what we're waiting for. I can understand from a Madisonian separation of powers standpoint if a fiscal hawk said, hey, there's a Democrat in the White House, he's going to veto anything, there's nothing we can do. But when you have all three branches of government, or in this case, bicamerally, the legislative branch, both Senate and House and the White House, you ought to be able to do something far more bold than this. And so even if it is slowing the growth of deficit, which, by the way, even that presupposes that we don't have a recession. I mean, if we have a recession, government revenue collapses. And so there's a lot of risk in it. But that's the main issue, is we're playing with fire around our decreased margin of safety. Running over 100% debt to GDP, you really start getting a significant diminishing return on government spending. And then to your point you made earlier, and it has to be made over and over, the percentage of spending now that is mandatory versus discretionary has inverted. Yeah. We used to have a lot more discretion because about 70% was discretionary, 30% was mandatory, and we've now turned that on its head. And so if people think they're going to have a serious conversation about budget reform and not talk about Social Security, Medicare, Medicaid, they're fooling themselves.
Yeah. The other sort of big issue and big bone of contention in government, and this is between elected officials and the central bank, is President Trump has been very critical of Fed Chairman Jerome Powell's sort of course of action with interest rates, and has at various times tried to apply at least rhetorical pressure to get him to lower rates. This is tied into a lot of frustrations that American consumers have in terms of, we talked about the housing market at the very beginning as something, this is something that, this affects the interest rates that consumers face in, auto loans, home loans, these sorts of things. It affects all sorts of businesses with these rates. What are your thoughts on sort of where rate levels are at, if President Trump is right to sort of make the appeal to lower rates? And then there's also a separate question of if it's appropriate for a president to make those sort of requests to the head of the central bank?
Well, this is going to be very frustrating for some listeners because I insist on answering with the appropriate honesty and nuance that the situation requires. And nuance isn't very popular these days. I'm in the sort of tension right now of believing that the president is incredibly wrong to publicly articulate his desire and believing he's right in what he's asking for.
Yeah.
But then also believing that rates would have been cut if he hadn't have asked for them by now.
This is a very interesting, and I've seen this argument made, is that one of the reasons that Chairman Powell may be keeping rates where they're at is simply to preserve the perception of the central bank's independence. Yeah.
And I am 100% convinced that that is what has happened. Now, there are some who say Jay Powell is wrong if he believes that it would be wrong to cut rates just because the president asked him to. It's also wrong for him to not cut rates just because the president asked him to. And I don't disagree with that. But I'm more speaking to the pragmatic reality that he is concerned about the appearance of succumbing to the jawboning of the president. Now, let's put aside the easy part, that the president should not be calling them stupid and name-calling. And at one point in his first term, he said he was a worse enemy of the United States than Xi. You know, I mean, so some of that excessive stuff I don't like personally. Look, when Bill Clinton in 1994 was concerned that Alan Greenspan had tightened rates more than expected, he didn't say a word to him. But then Vice President Al Gore kind of had an eyebrow-raising moment with them and brought it up. And I think in behind closed channels, I'm not so naive as to pretend that I don't think the Treasury Department and the Federal Reserve have open accord. We know they do whenever the financial crisis happened. Paulson and Bernanke were on speed dial. And during COVID, Secretary Mnuchin and Jay Powell were on speed dial. So there isn't this wall of separation between the central bank and the Treasury Department, but for an elected political figure who essentially has a permanent incentive to want easy monetary policy, to be playing a role in setting policy, which at one point the president was saying, like, I should get a vote at the table on this. And then even in the war of PR, pressuring, I think it's problematic. And so I would favor a better pretense of independence. But then when you get to the substance of the matter, I believe that the policy rate right now is unnatural, meaning it is set above the level at which it would neither incentivize a slowdown or an acceleration of activity. Now, that number itself is undefinable.
Yeah.
And this is one of my problems with modern monetary policy, period, is that we believe a group of a dozen PhDs even have access to this sort of Gnostic information as to what the natural rate is supposed to be. I think buyers and sellers, lenders and borrowers in open market activity should be able to set what an overnight lending rate is and not have it imposed upon them top down. But that's a criticism of central banking, period, or at least the way in which central banking is done now. But to the extent we've asked the Fed to do it, it's a little confusing to me why the Fed would set the rate where it is. Now, some would say because they're worried about inflation and that the tariffs will create inflation. Even if the tariffs create inflation, and what people mean by that is not actual inflation. Yeah. They mean higher prices on tariffed items. Inflation is a monetary phenomenon, always and forever, where there is too much money chasing too few goods. Tariffs can become inflationary when you're not getting enough goods because the slowdown in trade slows down production. But when people say, well, this item at the store is higher now because of a tariff, but all things being equal, that's still not inflationary because it means some other item may be lower. They become inflationary if it puts downward pressure on production. But what does that have to do with monetary policy? What does that have to do with the setting of interest rates? Even that form of inflation is not the purview of the Fed. Their interest rate setting is not going to curtail that. So I believe that the Fed is behind the curve, and by the way, so do they, because they said so. They lowered rates 100 basis points from September through January, and there is more of a reason to be cutting now than there has been since. So I've come to believe that they would have cut rates another 50 basis points in the last 60 days if it weren't for the pressure the president put on them.
Yeah. What would it look like for the American economy if, tomorrow, the next day, the next month, Chairman Powell would lower rates? How would that affect markets? How would that affect American businesses and the American economy?
Yeah, if they were to cut rates, keep in mind, there's always the present policy tool and the forward guidance about ongoing policy intentions. Mm-hmm. And so if they were to cut rates now and then say, well, now we're not going to do it again, that's probably a break even. Mm-hmm. If they were to say, we still think there's going to be a couple more cuts that we've already put out into the future end of the curve, and we're doing a couple more now, it would be more stimulative. But I don't mean stimulative meaning drive stock prices.
Yeah.
Stock price valuations are not struggling here. They're not suffering at all. 23 times earnings in the S&P. A lot of the big tech companies trading at 40, 50, 60 times earnings. We're not struggling for low valuations and risk assets. It's real estate.
Yeah.
It's in variable debt resetting at much higher rates. A lot of hotels aren't getting built. Cost of capital is 8, 9, 10%. A lot of multifamily apartment construction has had to slow down. Those deals are very levered and they don't pencil. Mm-hmm. They generally have 60, 70, 75% loan to value. And there's a number at which it works, a number at which it doesn't. And a lot of those projects have slowed down. Now, that's by design. Mm-hmm. That's what the intent of using monetary policy is, to slow or accelerate economic activity. But I think that ultimately housing has frozen. Mm-hmm. And I don't care what housing prices are, meaning if they were to drop. Mm-hmm. The problem right now is that there's no activity. Yeah. And that will have a knock-on effect in construction, and we desperately need a new supply. It will have a knock-on effect in renovation, landscaping, architecture, furnishings, home renovation, mortgage, title. There's a lot of adjacent sectors of the economy connected to housing, and if that affordability issue doesn't get fixed, which means more supply and lower cost, I let housing prices come down. I don't care. But I think that it will end up spilling into the real economy if we continue to run at this depressed level of activity of single-family residence activity.
So there's been a lot of interesting noise from some prominent folks involved with the Democratic Party in various ways in the United States. I think Ezra Klein and Derek Thompson have a new book, Abundance, in which they talk a lot about the housing regulatory environment. Yep. And about sort of reforms that they see, possibly beneficial there. At least, if not in substance more market friendly, at least using sort of market friendly language. How much can those sorts of YIMBY reforms, how much of that is that really the obstacle to housing, or is it more this credit situation?
Oh, it's almost entirely what Derek and Ezra are getting at. Yeah. As myself, as a center-right conservative, it drives me crazy that a couple center-left moderate liberals are the ones bringing it up, because I'm 100% on their side. Yeah. This ought to be a bipartisan issue, and I make the case in a sister podcast to this called Capitol Record that I host. In a recent episode, I argue that YIMBYism really ought to be a conservative issue. Yeah. Around zoning laws, around the regulatory burdens, around the NIMBYism attitude, where essentially well-to-do boomers show up at city council meetings and protest any additional new housing supply coming to market because they don't want new building, new construction, new traffic. Look, we are underbuilt on single-family residence in America, period. And that supply deficit has pushed prices up to a place where now many people with good savings and good jobs can't afford to live in the neighborhoods. And the amount of people in America that can't afford to buy their own home is higher right now than it was before our housing crisis in 2008. So that is, to me, the metric that matters, and it's solved by, as always, by supply. Demand isn't going to go down. People want to own a home. People like the independence of having their own property. There's something about building equity. There's something about the pride of homeownership. That number is not for 90% of people. It's not for 80% of people. We learned in the financial crisis trying to get people to buy a home who can't afford a home is a bad idea. But there's something in the range of 60 to 64% of Americans that want to own a home. Demand is not the problem. Supply is. And YIMBYism is a great solution. Now, I don't favor subsidies to low-income, high-density home developers. That's not what I'm referring to with YIMBYism. Yeah. And I don't know that Derek and Ezra get into that. Derek Thompson, Ezra Klein get into much of that. But what they're referring to is greater flexibility on zoning requirements, allowing more subdivision of properties, far greater path to permitting, things like that will just help us accelerate the building of new housing. Now, that's not to say the credit side doesn't matter.
Yeah.
We put a lot of restrictions on lenders. First of all, these two are connected in that a lot of investors and lenders can't extend credit on housing because they don't know the projects are going to get approved on the regulatory side.
Yeah.
So these things dovetail with one another as well.
What would it look like for a bipartisan movement like that to happen? Because one of the fascinating things in watching this sort of Klein and Thompson book is it's gotten a lot of sympathetic reviews from center right and right wing folks, market oriented folks are like, we're glad they're seeing this, but they've gotten an extremely hostile reaction from folks further to their left.
Yeah.
And you have a mayoral race in New York City right now where one of the leading candidates has talked about freezing rents, these sorts of other solutions, proposed solutions to housing. It seems like everybody's agreed that housing is a live, relevant issue, but we have just starkly different approaches for it. Why do you think that these sort of rent control models, these sort of low-income housing projects, why do you think they still have political traction? And why are so many people still resistant to the sort of market-oriented reforms of the housing sector?
Well, there's two different answers because there's a left-wing opposition to market reforms, but there's a right-wing opposition as well, and they're different. And similarly, for those of us that are pro-YIMBY, you'll find that oftentimes there's a coalition of left and right, but they're coming from a different place. I mentioned the issue of subsidizing high-density developers. I'm all for high density, and I'm all for people who don't like high density. I'm for consumer choice and where people want to live. But I'm not asking as a YIMBYist for government to put its thumb on the scale and say we're going to pay developers to do something that we're not going to pay others. I don't think the government should be using taxpayer resources to pick winners and losers, and that includes the issue of high density versus suburban development versus rural building, what have you. What I do favor is removing impediments to all the above. Mm-hmm. That, to me, is a very consistent market-oriented YIMBYism. The left-wing opposition to market solutions, or in the example you used, why people still believe rent control, is because they see it as quick. Mm-hmm. But what they don't understand, again, is the economic idea that rent controls disincentivize new supply. That there are less people that want to come build when they have price controls limiting the opportunity set. This is the great lesson of any place that has ever tried price controls. The solution is to remove impediments to new construction. And rent control is an impediment to new construction, so it's counterproductive. But it seems like a quick fix, even though it's a long-term problem or exacerbates the problem. I have to say that on the right, their opposition to YIMBY solutions is far more frustrating because they're almost entirely devoid of even the pretense of principle. Mm-hmm. It's mostly rooted to preference of I simply don't want the nuisance in my neighborhood. I have my house I like. I'm happy. I have a lot of equity. In fact, you not having more houses around me, limit supply has boosted my equity. Leave me alone. ultimately, those people made their money in a growing economy that was building new neighborhoods and businesses and houses and jobs and opportunities throughout the decades that led to that person's adult life. So I find it entirely selfish for them to then get up to the second floor, kick over the ladder, and pretend they don't know how they got there. I think that NIMBYism on the right is even more inexcusable than it is on the left.
One of the things when we began this conversation, you talked about the driver of the American economy is an American culture of enterprise and a robust set of American institutions that allow commercial society to flourish. Is there a distinctly cultural component of home ownership where when we create obstacles to home ownership, it has, there are all sorts of things that can lead to market inefficiencies in the abstract. But when you create when you create inefficiencies in the housing sector and artificially constrict the supply, make it harder for people to buy homes, does that also degrade that culture in a unique way? Because home ownership is very central to people's aspirations, to people, you talked about, people like to own property. They like to have an actual, a literal stake in their communities. They like the independence that this provides. Is there a way that like housing, and does that result in housing then? It's an easier for that market for prices to get out of control, because there's a strong element driving consumers, an aspirational and a good desire to want to have a home, to build a stable family life, where, the thing that would make economic sense would be to rent, but the desire's still there, and when you frustrate that, I think that there's a way in which homeownership, in particular, the way it works with American culture, with the way that it's tied to family formation in this country, like, is maybe uniquely disruptive, or at least there's like a multiplication of effect when you overregulate housing, that you see even worse consequences for the American way of life. It's a big part of how we style the American dream.
I have very strong opinions on this subject, and some of them are a little contrarian.
Let's go.
My very first book I ever wrote was called Crisis of Responsibility, Our Cultural Addiction to Blame and How You Can Cure It. And it was my work in the aftermath of the financial and housing crisis of 2008, and did an exhaustive multi-year study into the causes of that crisis. I think it's really important to separate what you're talking about this natural desire for homeownership for what has become the American definition of a desire for homeownership. I think what you're describing and what I'm hearing from you are you're kind of poisoning the well a little bit when you talk about people that want to own homes and have strong communities.
Yep.
Well, that part is the benefit of homeownership, but it's presupposing things that I think is very romantic in traditional homeownership relative to what people mean today, which is I want to own a home to then get quick equity that I can flip into a new home. Mm-hmm. And I've done an intense amount of study on the subject. I don't believe that there is any evidence of people with low equity in their home valuing the community. In other words, the 2003, 2004, 2005 vision of home ownership is not the vision of home ownership that was romanticized by President Bush at the time.
Yep.
And a lot of the folks that talked about Fannie and Freddie and Community Reinvestment Act and these different ideas, this American dream home ownership idea. American dream home ownership is generally described as a financial characteristic. That you get a home paid off and you have this big asset and it goes up in value 10% a year. How does it go up 10% a year if wages are going up 3% a year, if the economy is growing 2 to 3% a year? houses can't go up 10% a year for years and years and years if wages are going up 2 to 3% a year without creating an affordability crisis. Ultimately, the baby boomers' timing coincided with the right side of that trade. They got a disproportionate amount of equity appreciation. And I think the cult of home ownership was largely poorly defined, that it was a way to make easy money, treating your house like a trading card, but not as a place to really build a home. Not merely a house, but a home where you raise a family, where you do holidays, where you create memories, where you discipline your kids, where you laugh with your kids, where you have meals, where that's what we think of as home ownership. And I don't think that's what most people are talking about anymore. They're talking about, I got a starter home and I made $100,000 and flipped it into another home where I made $300,000, where I flipped it another. And now it's a keep up with Joneses type of thing that is far removed from the sentimentality of what you're describing, in my opinion. I value home ownership because I'm presupposing the things that are actually relevant. Thrift, responsibility, equity, affordability. So if someone says, I own a home, I was able to somehow scrounge up a few nickels to put 5% down, I got a 95% mortgage, and I'm doing an interest-only loan, but I'm a homeowner. No. I value someone who saves the down payment, 20, 25, 30% down, that their mortgage payment fully amortized is a reasonable percentage of their income. They don't say, I can't take a vacation, I can't go out to eat, but at least I have this home. It's a reasonable percentage of income. That's the type of homeownership we ought to prize and celebrate. And that's why I say those numbers don't really change a lot. That's 60, 62%. When you start saying, I want to get 74% of people to fit in that bucket, they don't fit.
Yeah.
And there's just various reasons throughout history that's always reverted to a certain mean.
Mm-hmm. So I've always looked, so I've been a homeowner. I'm currently not a homeowner. Grand Rapids is a fabulous place, and it is a tight real estate market right now. I've got a lot of friends that, I am now a geriatric millennial, but, I have friends with, kids in elementary school, middle school, starting to get high school age folks. And a lot of these folks felt like, and this is part of it's a Grand Rapids cultural, sort of religious cultural thing. It's like, you get married. Yeah. Maybe you can have one kid in an apartment. Yeah. But the moment you have a second kid, there's a tremendous amount of cultural pressure to, like, by hook or by crook, get your own home, to do all those things, to do the holidays, to make the memories, to make it a home, that sort of thing. I am analytically minded enough that I have always been, I bought a home back in 2014 when it was a very, very great financial proposition to do that. I'm in the rental market now, and I look around and I look and like, it seems all out of whack. It seems like there are great homes in this city. There are great apartments in this city. There are great homes you can rent in this city. And like, no matter how I plug the numbers in the spreadsheet, it's just like the market seems irrationally priced. How do you make sense of those sorts of phenomena? And that's not the same anywhere. My wife, her grandfather, or her grandmother's brother passed away. They're on the other side of the state. They're in Saginaw, Michigan. And the family was talking about what are they going to do with the home of this great uncle. And they were like, oh, well, we're going to, turn off the water and the electricity, and we're going to give it to the city. Mm-hmm. Because to bring it up to code would be to make it a losing proposition in terms of a sale. And part of that's because in Saginaw, Michigan in 1960, there were 120,000 people, and today there's 60,000 people. And there's just too much housing stock. Yeah. It's just a different world.
There are some cities like that. That's an exception, not the rule. That creates a very different set of economic challenges. When we talk about the irrational exuberance in house prices and everything just seeming to be excessively euphoric, if the proposition was there's someone who has stable income, they can afford the monthly payment, they're going to put 20, 25, 30% down, and they intend to live there for a long time, then what do they care?
Yeah.
What is the risk? The only reason people are talking about what they're buying it for is because they're thinking about what they're going to sell it for.
Mm-hmm.
Now, it matters a lot what you're going to buy it for, even if you don't intend to sell it, if you have inadequate equity or you could lose the home.
Yeah.
But if you have the stable income, you intend to be there, and you don't even intend to sell it, then that purchase price issue becomes far less relevant. We have to look at an investment asset at the value at purchase price because it affects, by definition, expected rate of return. The house, a primary residence, is one of the worst investments ever made in the history of mankind.
Yeah.
It has tremendous carry cost of maintenance, of insurance, of oftentimes HOA and dues, of property taxes, and of carrying cost via debt service. And then years and years later, people say, I bought a house for $250,000. I sold it for $1 million. I mean, unbelievable. I tripled, quadrupled my money. And you go, okay, well, let's do the math here. You look at when you bought it, what you paid into it over the years, what you sold it for. You go, yeah, you're up 3.1% per year over 30 years. It's a very underwhelming rate of return. It is not owned as an investment asset. And where it is being owned as an investment asset, that's a totally different subject than what we said we were talking about, which is home ownership as a dream, as a part of quality of life, of memory building, of home formation, of family. That's different than I want to buy Microsoft stock at 100 to sell it at 1,000.
Yeah.
So I think we have to separate those objectives. What I say to people is, if you think you're buying a home to flip it a couple of years and you're going to make easy money, then this euphoria right now and high prices in places that are hot like Grand Rapids, that's a very bad deal. But if you think you're going to buy a home and you have good income and you could cover the payment and you have a down payment and you're going to have protective equity, then who cares? You're basically going to buy it as a place to live in a long time. So I kind of see both sides of it as being very relevant. But the problem is very few people are discussing it in the context of homeownership with that objective.
Yeah.
And a lot of people now are sociologically moved by the fact that their peers are getting homes. They want to be able to get a home. There's a certain mobility that's very understandable there. People went to college. They went to grad school, they got good jobs, they have good income, and they're like, why in the world can I not afford a decent place to live? That frustration's real, but that is solved by more housing supply. And here's the problem. So many were the millennial generation getting married later and later incentivized a ton of construction of multifamily housing. We ended up with a lot of these cool cities. You see Denver, Austin, Nashville, very desirable places to live, high quality of life, well amenitized. They built tons of high density. They built tons of multifamily apartments, condos, but not for family because they were getting married at 37 instead of 25.
Yeah.
But now for young marrieds that are looking to form roots, to drop a foundation and start having kids and all that, there's a deficit of supply for single family stock.
Looking ahead at the economy. I mean, economic forecasting is a difficult business.
It's there to make astrologers look good.
Yes.
Yeah.
And if anybody was really new, they wouldn't tell you because they would be busy making good on that knowledge.
Yeah.
But you're somebody who's paid very close attention to the American economy for a very long time, and you've seen, and you've got your eye on certain trends that are like very worrying in the economy. I'm going to ask you to put that forecaster hat on with all those caveats. What are the challenges that we're facing, and there's a lot of great cultural bedrock in America that's still there, that's still driving a lot of innovation, a lot of growth. We've got very robust institutions, but we've had all these problems we've been discussing. How does that cash out in, I guess near term of, next 10 years, next 5 years, not tomorrow, not next week, but in the immediate future, when we've got these big challenges, how does that look to you?
Yeah, 10 is impossible to predict, and so I'm not punting or chickening out. I'm just giving a very honest answer. 10 is impossible, and 5 is pretty darn hard as well. But I think that the general assumption in a market-oriented economy is that markets work very well as efficient allocators of capital, distributors of risk and reward. And so I expect good real economic growth other than when bad policy impedes it. And then I expect cyclical recessions along the way that have to come along and purge out excess and so forth. And in the very short term, the uncertainty around trade policy is a real issue. Longer term, I expect real economic growth to be positive but below trend line. A more stagnated economic growth because we're not wiping away $37 trillion of debt. That the amount, right now, government spending as a percentage of GDP it's come down from about 26, 27% to 22, 23, but it's not back down to 17 or 18% where it was for decades of really good economic growth post-World War II. So that excess of more resources going towards governmental spending versus private sector allocation, in the next 10 years, that takes away from economic growth. Yeah. The question is, does it take away where we go from 3 to 2 in real growth, meaning let's call it from 5 to 4 in nominal growth? Yeah. Or does it go from 3 to 1? 3 to 1 real economic growth, that creates a lot of societal angst, a lot of problems. 3 to 2 is more muddle through. But that's probably the big debate. If anyone thinks we're getting back to 4% Reagan, Clinton era real economic growth, it's not going to happen. I don't think it's been a good bet to ever bet that America goes to 0% prolonged economic growth. We still have had the vitality and vibrancy to get off of the 0 level. But the difference between 2 and 1, that's a very big difference in what it means socially in the country. And that will probably be the big question in the next 5 to 10 years is not are we going to be really strong or really weak, because I don't think it'll be either, but what level of okay versus a little better than okay are we going to be? That's probably the crux that I'd be looking to.
The last question I want to ask, because you get some people these days, one thing that didn't come up in any of our conversation, in any of your assessment, was AI. And there are a lot of people placing the bet that AI is going to lead to this sort of larger scale deployment, development, whatever, is going to lead to substantial sort of breakout growth of, we're talking that Reagan Clinton type growth, or, some of the sort of people who have drunk deep enough of the Kool-Aid that, we're going to see sort of unprecedented growth. What is your evaluation of sort of the economic impacts of these large language models that, a lot of people are now using every day in all sorts of ways, some of which are very productive and interesting, some of which are just very deeply strange and anti-human. But, there are folks out there that are investing a lot of money in this, thinking that it's going to fundamentally change not only the way the American economy works, but the world economy as a whole, and that we might see this explosive growth from that. What do you think about that?
Well, I think you have to divide it up into 2 different categories. Those that are believing AI is going to be an economic growth engine just because there are others who believe AI will be an economic growth engine. In other words, their optimism is rooted to that the makers of AI are going to there's going to be so much capital investment as there is now.
Yeah.
The so-called hyperscalers are spending so much. Now, remember, every company's capital expenditures is somebody else's income, and that becomes an opportunity set. Well, that's different than speaking to the other end of it. Once we're done with this huge capital outlay, what is the new efficiency we're getting? What is the new innovation we're getting? What is the higher quality of life we're getting? What is the enhancement to productivity? The internet fundamentally changed our lives. Productivity stayed about the same.
Yeah.
Now, I think the internet could have enhanced productivity more, but we chose to leverage the internet's usefulness to just work a little less, exert a little less. So we adjusted accordingly. I am far more blown away by what the air conditioner did, the refrigerator did, the automobile did, the personal computer did, and the internet did to our quality of life than I am what TikTok has done. With AI, I am not an AI skeptic, and I'm not an AI bear, but I'm not an AI bull, because I think that we do not know what the efficiencies will be that will ultimately matter. That first category I talked about, I'm fully unconvinced that something becomes an enhancement of productivity just from the very investment in it.
Yeah.
There has to, at the end of the day, the internet was not useful just for eBay. It was useful for Procter & Gamble, right? There is a real life efficiency that has to kind of permeate. The Census Bureau the other day pulled 1.2 million entities. 9% American businesses are using AI in their production of goods and services. And that 9% included like voice automation and things of that nature that really kind of predate GPT.
Yeah.
But is language learning as a generative AI tool, is that going to end up fundamentally driving greater productivity? It very well could, but I don't think it will without making some mistakes along the way. I think that there will be miscalculation, and that some of the winners will end up being losers, and some of the people that aren't on the radar will end up being winners. That happened with the internet. It happened with the cloud. It happened with other technological advancements. So I would say that I have a bit of a wait-and-see approach. I do not believe AI is going to ruin our world, and I do not believe it will fundamentally transform our world. But on the other side of this massive investment, I think there will be enhancements in productivity that will surprise us. That's what I see as the outcome.
Let's hope it's a great surprise. David, thank you so much for being with us.
Thanks for having me.
Thank you for listening. If you'd like to learn more about Acton or hear more of this podcast, please visit acton.org/podcasts. Otherwise, we'll see you next week.